Right now, something interesting is happening in the crypto market. While most people are waiting for confirmation, while Twitter is quiet, and while prices are still moving sideways, smart money is already accumulating. And by the time the crowd realizes what's happening, the best entries are usually gone. Most crypto investors make the same mistake every single cycle. They wait, they hesitate, they wait for the perfect moment. Then suddenly, prices start moving fast. Green candles appear everywhere. Influencers start talking. Thumbnails scream, 100x opportunity, and that's when emotions take over. People buy not because the setup is good, but because they're afraid of missing out. Smart money doesn't play that game. They position early. They buy when things are quiet, and they sell when hype is loud. In this video, I'll show you where smart money is positioning right now, using market structure, on-chain behavior, and accumulation logic. No hype, no meme coins, just smart positioning before the next major move. And if you want data-driven crypto insights instead of noise, make sure you're subscribed. This channel is built for investors who want to stay ahead, not chase pumps. What is smart money? Before we dive into specific cryptos, let's clarify something. Smart money doesn't mean insiders or guaranteed winners. It refers to institutional investors, large funds, high net worth individuals, experienced market participants. These players don't buy breakouts on Twitter hype. They look for accumulation zones, strong fundamentals, long-term narratives, asymmetric risk to reward setups, and most importantly, they buy before attention returns to the market. Now let's look at where that behavior is showing up. Ethereum, ETH. Ethereum is one of the clearest examples of smart money positioning. While retail attention has shifted to smaller altcoins, large investors continue to treat Ethereum as core infrastructure. Why? Because Ethereum isn't just a coin. It's the backbone of DeFi, NFTs, Layer 2s, and real-world asset tokenization. On-chain data shows long-term holders are not selling. Exchange balances continue to decline. Large wallets are accumulating during pullbacks. This is classic accumulation behavior. No hype, no excitement, just quiet positioning. From a market structure perspective, Ethereum is building a strong base relative to Bitcoin. And historically, when ETH starts outperforming BTC, it often signals the early stages of an altcoin expansion. Risk, of course. If Bitcoin loses major support, Ethereum will feel it too. But smart money isn't buying for tomorrow. They're positioning for the next phase of the cycle. Chainlink. Chainlink is one of those projects that never disappears, even during bear markets. And there's a reason for that. Chainlink plays a critical role in crypto infrastructure by connecting blockchains with real-world data. Smart money likes projects that are already used, are difficult to replace, have long-term relevance. On-chain metrics show consistent accumulation by large holders, especially during periods of low volatility. This tells us something important. Big investors aren't trying to flip Link quickly. They're positioning quietly. Another interesting detail. Chainlink tends to move after long consolidation periods. It's boring. Until it isn't. And smart money understands that boredom is often where opportunity lives. Solana has had one of the most interesting recoveries in crypto. Many people wrote it off completely, but smart money didn't. Instead, we saw gradual accumulation, increased on-chain activity, growing developer engagement. Solana benefits from one powerful narrative: speed and scalability. Institutions don't care about drama, they care about functionality and usage. When you look at wallet behavior, large holders have been accumulating during dips, not distributing. That's not random. However, Solana is also a higher volatility asset. Smart money treats it as a calculated risk, not a blind bet. Which brings us to an important lesson. Smart money doesn't go all in on one idea. They build portfolios. Arbitrum, ARB. Layer 2s are one of the strongest long-term narratives in crypto, and Arbitrum sits right at the center of that. As Ethereum scales, Layer 2's benefit. What's interesting here is behavior, not price. Despite price volatility, development activity remains strong, TVL stays relatively stable. Large wallets continue accumulating. This suggests conviction. Smart money understands something retail often ignores. Infrastructure grows before price reflects it. Arbitrum isn't about hype, it's about positioning for Ethereum's next growth phase. HOW Smart Money thinks, here's what most people don't realize. Smart money doesn't ask, how high can this go? They ask, what's the downside? And how likely is the upside? They care about risk management, time horizons, capital preservation. That's why they buy during uncertainty, not excitement. If you're watching this and thinking, prices aren't moving yet, that's usually the point. Risk and reality check. Let's be clear, nothing in crypto is guaranteed. Markets can stay sideways longer than expected. Macro conditions still matter. Bitcoin still controls the overall direction. Smart money can be early, but they're never reckless. That's why position sizing and patience matter more than predictions. Now here's the part most people completely miss. By the time headlines say, crypto is back, smart money is already planning exits. Retail buys excitement. Smart money buys silence. The goal isn't to predict the exact bottom. The goal is to position intelligently before momentum returns. Smart money is already doing that. Quietly, patiently, strategically. If you want to stop chasing hype and start thinking like smart investors, subscribe to the channel. I break down the market using logic, data, and long-term strategy so you can stay ahead instead of reacting late. Thanks for watching, and I'll see you in the next one.